How are immediate annuities taxed? Have you ever wondered how immediate annuities are taxed? If you are considering using them as part of your retirement financial strategy, understanding their tax implications is essential. Immediate annuities can provide a steady stream of income shortly after you make a lump sum purchase. However, the way these payments are taxed can vary based on how the annuity was funded. Let's break it down. First, we have qualified annuities. These are purchased with pre-tax funds, such as money from a traditional individual retirement account or a 401(k) plan. Since you did not pay taxes on the contributions, every payment you receive from a qualified immediate annuity is fully taxable as ordinary income during retirement. On the other hand, we have non-qualified annuities. These are bought with after-tax dollars. Since you already paid taxes on the principal, only the earnings portion of each payment is taxable. This means that the principal portion returned to you is tax-free, which can be a significant benefit. To determine how much of each payment is taxable, the Internal Revenue Service uses something called an exclusion ratio. This ratio helps identify how much of your payment is a tax-free return of your original investment and how much is taxable earnings. The principal is returned evenly over your expected payout period, which is not taxed. The earnings portion, however, is taxed as ordinary income. For example, let's say you invest $100,000 in a non-qualified immediate annuity when you turn 65, and the insurer expects you to live for 20 more years. The Internal Revenue Service divides your investment by 20, meaning $5,000 of each annual payment is considered a tax-free return of principal. If your annual payment is $8,000, the remaining $3,000 is taxable income. After 20 years, if you are still receiving payments, those payments will be fully taxable. Another important point is that annuities grow tax-deferred. This means you do not pay taxes on earnings until you receive payments. However, if you withdraw from qualified annuities before the age of 59 and a half, you may incur a 10% penalty on the taxable portion, unless certain exceptions apply. Since immediate annuities usually begin payments after retirement, this penalty is generally not a concern. Immediate annuities can be a great way to ensure predictable income during retirement. Understanding how they are taxed can help you plan your withdrawals and estimate your after-tax income accurately. The choice between qualified and non-qualified annuities can significantly affect your tax liability, so it is essential to consider this alongside other sources of retirement income. In summary, immediate annuity payments are taxed based on whether the annuity was purchased with pre-tax or after-tax dollars. The principal portion of payments from non-qualified annuities is tax-free, while earnings are taxed as ordinary income. For qualified annuities, all payments are taxable. The Internal Revenue Service life expectancy tables determine how much of each payment is tax-free until the principal is fully returned. Understanding this tax structure is vital for effective retirement tax planning.